Stop drawing lines on your chart and hoping for the best. Have you ever felt like the market is watching you? You set your stop loss, price hits it with surgical precision, and then only then does it fly in your predicted direction. It's frustrating, right? The reason isn't bad luck. It's because you're drawing levels where everyone else is told to draw them, making you the perfect liquidity for big banks. In today's video, I'm going to show you how to stop being the prey and start trading like a predator. Welcome to my channel. We are building a sanctuary for traders who want to master the markets from the ground up, from absolute basics to elite institutional strategies. This is our foundational lesson. But even if you've been trading for years, the advanced techniques I'm about to reveal will completely change your perspective on price action. You are tired of messy charts and inconsistent results. This is where your journey truly begins. Before we break down the charts, do me a quick favor. Hit that subscribe button and smash the like icon. By doing this, you're telling the YouTube algorithm that you prioritize high-quality trading education, and it helps me grow this community to support more traders like you. Don't forget to turn on the bell. You won't want to miss our upcoming advanced series. Today, we settle the #1 debate in trading: how to find support and resistance levels that actually hold. I'm handing you a professional blueprint, a checklist of 6 golden criteria that big players use to identify where the real money is waiting. Comment below with "I'm ready" if you're committed to mastering these levels today. Now, let's get into the mechanics of price action. Let's start with the absolute basics. What is support and resistance exactly? Support and resistance represent price points or zones where the market has historically shown a reaction and may keyword potentially respond similarly in the future. Think of support as a floor. It's a price level where buying interest is strong enough to overcome selling pressure. When price hits the floor, it bounces back up. Resistance, on the other hand, is like a ceiling. It's an area where selling interest is strong enough to stop the price from rising further. When price hits the ceiling, it gets pushed back down. But why do we have to draw these levels in the first place? First, we draw them because once price approaches these areas again, high probability trade opportunities arise. These levels act as a visual reminder to pay attention and look for price action patterns. Second, having these levels pre-marked allows you to identify high-probability trade setups as soon as price approaches them, serving as a vital signal to begin your analysis. Now, why do we have to draw in support and resistance levels? We draw in support and resistance levels because once price gets back to these levels, there are possible trade opportunities that arise, and you want to have these levels drawn in already as a reminder to look. Now, there is specific criteria we look for in order to identify support or resistance levels, which we are going to list for you right now. As I said before, not every peak and trough is a valid level. We use specific criteria to filter out the noise. Here are the 6 traits we look for. 1. Extreme swing highs and lows. We look for the absolute highest and lowest points price has reached in a recent period. These are the major turning points where the market sentiment completely flipped. 2. Multiple rejections. We love to see price touch an area and bounce away multiple times. The more rejections a level has, the more significant it becomes. It shows that many traders are watching and acting on that specific price. 3. Obvious levels. This is the squint test. If you have to squint or zoom in really close to see a level, it's probably not a good one. A strong level should jump right out at you. If it's obvious to you, it's obvious to the world. Finally, again, to make this clear, the level should be obvious, and it should jump right out at you, meaning you should be able to spot the level right away when looking at a chart. 4. Drastic moves. Look at how the price left the area. Was it a slow, grinding move, or was it a sharp, aggressive rejection? We want to see a drastic move away, as it indicates a huge imbalance between buyers and sellers. 5. Role reversal. This happens when a previous resistance level is broken and then becomes a new support level, or vice versa. This flip is one of the most reliable signals in technical analysis. It can be understood that the level has acted as both support and resistance, meaning it was respected from both sides. 6. Recency. The market has a memory, but it favors recent history or formed in a recent time period. A level formed 2 days ago is generally more relevant than a level formed 2 years ago. Always prioritize levels that have been recently respected. Keep in mind, you don't need a level to fulfill all 6 criteria to be tradable, but the more criteria it meets, the higher the probability of the trade working in your favor. Let's look at some real-world examples. Now we're going to go through each of the trades we just listed, but more in depth on the charts. On the chart pair, we can see a clear extreme swing high. Price shot up, hit a wall, and crashed down. This is a prime area to look for shorts if price ever returns. Moving over this chart, we see trait 2, multiple rejections. Price touched the 0.98 level 4 separate times and failed to break through. Each time it touched, it left a long wick, signaling that buyers were stepping in. On the chart, we see a drastic move. After hitting a minor resistance, the price didn't just drift. It plummeted with large bearish engulfing candles. This tells us that institutional sellers are active in that zone. Finally, we can observe role reversal. Price broke a long-standing resistance, came back to retest it, and then that old ceiling became a new floor. This is where smart money enters the market. Now, starting from the very top, we spot this level at the very top where price came up, hit, and reversed drum, so we draw it in. So what criteria does this level have that we previously listed that makes this a good level? Let's break it down. 1. This level is the extreme swing high, meaning it is the highest point that price has reached in recent time. 2. The level is obvious and it jumps right out at you and you should have spotted it within seconds. 3. The move away was drastic because, as you can see, price reversed significantly after it got here. And 4. There were multiple rejections of this level because if you look closely, there were 3 smaller rejections of this level. This is also what you can call a triple top. So moving on down now, the next level we spot is this level here with 6 rejections. Rejection 1, rejection 2, rejection 3, rejection 4, rejection 5, and rejection 6. So again, what traits and criteria does this level have that makes it a good level? 1. There are multiple rejections of this level, a total of 6 rejections. 2. This level has acted as both support and resistance. 3. The level was recently respected, meaning it is still valid in a current time period. 4. The moves away from this area are drastic. And 5. The level is fairly obvious, as you should have been able to see the reversals from this area very quickly. Now moving on down, we spot the 3 rejections here and draw in another level. So again, what criteria does this level have that makes it a good level of support? 1. It is the extreme swing low, meaning the lowest point price has reached in recent time. 2. There were multiple rejections of this level 3 in total. 3. The move away was drastic because, as you can see, price reversed significantly when it got here. 4. The level is obvious, as he should have easily spotted it when looking at the chart. And 5. It was recently respected and occurred in a recent time period. So there are other minor levels in between, but again, for this video, we want to keep things simple and focus on the key levels first. Again, as a reminder, just drawing in support and resistance levels does not mean you take trades blindly. Once price gets to these levels, you always need to wait and look for price action patterns. Now, should you draw lines or zones? Many beginners get stuck on this. A single solid line is clean, but price rarely stops at an exact pip. Multiple lines can get messy very quickly. There are 3 main approaches to draw line and zones. Single lines, effective if all reversal points align precisely. Multiple lines. Used to capture candle closes, though this can become cluttered. Our preferred method is using zones. A zone is a highlighted area that encompasses both the candle closes and the wicks. It accounts for market noise and false breakouts. When drawing zones, keep them thin and precise. Don't paint half the chart purple. Your zone should focus on where the most touches or interactions occurred. Treat them as areas of interest, not magic lines. So here's a pro tip. Don't draw in massive zones. Draw in a smaller zone that accommodates for the most amount of touches and points. Because let's say you were to draw this big zone here to accommodate for this low here. 1, it looks terrible, and 2, you'll end up confusing yourself with such a large area as it gets even worse once you start using multiple time frames. So instead, we opt to create a smaller level that accommodates the most levels that it can touch. And then this point here would be deemed a false breakout. We will dive deeper into false breakouts in another video, but the name is self-explanatory because you see this big momentum candle that breaks through support and assume that it will continue lower, but it ends up reversing drastically and faking out all the short sellers. Hence why you see such a big candle that followed the breakout candle. Now, we use time frame confluence to get around false breakouts, but that is something we will discuss in another video. And finally, at the very bottom, you have your swing low, and we just draw in the line. So as you can see, you have a nice clean chart with your key levels, not 100 lines. Again, there are other minor levels in between the levels we have drawn, but for the sake of this video, we're keeping it simple. The real question is, how do we draw these levels correctly on MT5? I'll show you step by step how to draw support and resistance on MT5 and how traders use them. Open your MT5 platform and let's get started. 1. How to draw on MetaTrader 5. Let's draw them on MT5 guides. Go to Insert, Objects, Shapes, Rectangle. Instead of drawing a thin line, draw a zone. Find previous highs and lows where price reacted strongly. Step 1. On MT5, select the rectangle tool. Step 2. Look for old peaks and valleys where the price reversed drastically in the past. Step 3. Draw the box to cover both the candle bodies and the wicks to create a buffer zone. 2. How to enter trades based on support and resistance. Step 1. Wait for the price to reach a support or resistance zone. Step 2. Look for a confirmation candlestick. For example, if price touches support, look for a hammer or a bullish engulfing candle. Plus, Step 3. Place the trade. Entry. Enter the trade right after the confirmation candle closes. Stop loss. Place it slightly below the support level to avoid being stopped out by minor price spikes. Take profit. Target the next support or resistance level. Support and resistance are like a roadmap in trading. Practice drawing them daily on MT5. Remember, trading is about probability, not certainty. Support and resistance levels give you a map, but you still need to follow the price action clues to navigate successfully. Always keep your charts clean and your mind focused. If you enjoyed this deep dive, please give this video a thumbs up. It really helps the channel grow and allows us to keep providing free education for everyone. For more strategies and knowledge trading, head over to our community. We have a lot of resources waiting for you there. Thanks for watching, stay disciplined, and I'll see you in the next episode.